Hello, Jags. This is Fahad. I'm back. Today, I want to take a look at Patterson Companies, symbol PDCO. This is a follow-up note after I just recently, a few minutes ago, issued the trade idea to buy October 48 strike calls for up to $2.45 and less. So once again, we're going to evaluate this based on the same three critical ingredients we talk about all the time: the fundamentals, the technicals, and the option activity. So to start off, let's take a look at technicals first. So here's a chart, right? Now, this is the annual chart. And sometimes, you want to take a step back and you want to actually really look at it over a long-term period and see how technicals are truly shaping up over here. And then it will give you a better judgment call, better way to assess which direction it's going from here. So I'm going to put this entire picture in front of you of PDCO, but watch this. Okay, so right here in August, after this this parabolic shoot higher, which was basically a blow off top, the stock pulled back sharply. This was back in August of last year. It pulled back in late or in September, October of 2015. It formed a bottom right over here. All right, this was around 42. And then it came back and made a newer low back in January of 2016. All right, so, and then it reversed based on a hammer reversal candle right over here. Then it came back and this made a higher low. This was back in May. Okay, this was also around 42, coinciding with the 42 over here. So, what do we have over here? We got an inverse head and shoulder. Let me draw it this way. So, let me go back to that. Here. We got a head and shoulder. So, if I go over here, draw a trend line or draw an oval right over here, there is your left shoulder. Here is your head, and here is your right shoulder. Okay, this is a head and shoulder formation. Very large. It's hard to see it's on an annual chart. Now, if I move this to weekly chart, you'll see it right over here. Here is your left shoulder, here is the head, and here's your right shoulder. Inverse head and shoulder formation. All right. On this weekly chart, if I draw a trend line, which comes down this way, you can see, now trend lines, by the way, are basically the neckline of head and shoulder. Doesn't always have to be an exactly straight horizontal line. I mean, I'm just talking pure technical gibberish over here, but just listen me out, for a couple minutes, and then I won't bore you with any more details. But the neckline in a head and shoulder formation does not have to be straight horizontal line. It could be simply a trend line. It could be a downtrend resistance, which is the case over here. So I'm just going to quickly show you on this weekly chart right over here. This is essentially your neckline right here. So head and shoulder, large inverse head and shoulder formation, followed by a very high breakout after the last time the company reported earnings. High volume breakout. It shot up from 46 to 50. Then after Brexit, it came back and tested that the breakout level previously from the earnings, and then it ripped higher big time. So basically, you have a successful breakout from large head and shoulder formation, inverse head and shoulder formation, a breakout on high volume, a pullback on low volume, and now start of new leg higher. So what I'm seeing from here is I see this gradually marching higher all the way to retest this high tick from way back from August, which is 53 level, which means my target is right here, all the way to $53 level. Going back to the daily chart, this is that trend line that I was talking about. Okay, so we broke out on this on very high volume. We tested that on low volume, and now we're breaking out again, and my target is all the way to retest of this 53 level, which is right here. And I think it's probably going to take a couple months to get there. At the same time, on the daily chart, while we have this beautiful hammer reversal candle formation over today, we got the MACD bull cross and the RSI bull cross. All right. Another way of taking a look at this is this stock charts. Okay, same exact picture right over here. We got the RSI bull cross, we got the MACD bull cross. Here's that high volume breakout that I was talking about after last earnings report. We came back, we tested that, and now we are starting to build, take next leg higher, and I expect higher highs and higher lows from here all the way towards $53 level. We're going to use a stop loss on this at the post-Brexit low, which was 45.35. So this is the level, which, by the way, coincides with the 200-day moving average, the pink line on this chart. So 45.35 is my stop loss. The target is 53. All right? So that's on the technical gibberish. And now we're going to look in the option market. What caught my attention today on this stock is when earlier today somebody bought 2,000 contracts, straight up bullish bet. No spreads, no nothing. They came out and they bought 2,000 contracts of October 48 strike calls, the same strike that I'm recommending buying. They bought it for $2.30 offer side when the bid and ask was 2 times 230. Okay, so the bid and ask was slightly wide. They bought it for 230, and I issued the alert at 245. My recommendation was to start buying these calls at $2.45. But they bought 2,000 contracts, so they paid. This is approximately $460,000 bullish bet. What's most important thing is that when you look at the open interest, there's absolutely no history here. You can look at the open interest, very low open interest here, very low open interest on the put option side. This will now become the biggest option trade we have seen in a very, very long time, a bullish bet in Patterson Companies October 48 strike call. So this is noteworthy to me. All right, so they're making a bullish bet that the stock is going higher and the technicals are breaking out. Now, on the fundamental side of the things. Now, there's a lot of ground to cover over here. So if I start wobbling a little bit, just hear me out, okay? But I want to explain to you a story over here that I believe is not fully built into consensus view. Now, a couple things to keep in mind, and I'm taking a lot of my talking notes over here from Credit Suisse, which appears to me, based on everything that I've read so far, Credit Suisse is the only analyst that has been following this story a lot more closely than anybody else out there. There are a few other analysts, but seems to have very random, very few notes come out in the last couple months. Credit Suisse comes out with every couple weeks. They are much more connected with the management. In fact, they had a big management meeting last week. All right, so that's another reason why I like the story, because I got some fresh thoughts on this. So here's the thing. PDCO is one of three dental plays in the United States. Okay, PDCO has a market share in the United States of 34%. It supplies dental equipment and to all the dental locations nationwide. It's got 34% market share, and the other two companies that have slightly higher market share are Sirona, which is symbol XRAY. Here is the chart, very stable, very good, and this one is also trying to break out. And the other one, the leader in this space, is HSIC, Henry Schein. Beautiful chart, consistently running higher. All right. Henry Schein is the leader with a commanding market share. Then comes X-Ray, symbol X-Ray, which is Dentsply Sirona, which is right here. And then the third in the group, basically, is our candidate that we're buying call options on, PDCO. Now, what's getting me interested in PDCO? Now, a couple things on the background. If you go back to this weekly chart, one thing you will see right here, this company, on the fundamental side of the things, this company trades at 11 times enterprise value, EBITDA over enterprise value, versus Henry Schein and Sirona, with the symbol X-Ray, trades at 13.5 times their enterprise value. Their EBITDA / enterprise value. So the stock is at minimum 3 turns lower than the entire industry. Or the PDCO is 3 turns lower than the entire industry. On a forward-looking basis, the difference in the valuation becomes even much more significant, with the forward earnings multiple will combine for X-Ray and Henry Schein at 15.5 times enterprise value versus PDCO trading at 11.3 times enterprise value. So the question becomes, how come Patterson is so cheap compared to everybody else? Two reasons for that. And I believe those two reasons are now fully baked into the consensus view, but the upside that's going to come from them are not baked into consensus view. Two things happen in the summer of 2015. So you have to go back to the daily chart. In fact, let me just put up the cleaner version of this, which is this right here. So if I go here and if I change that to this, so you can see a better picture. You see right over here in July and August when the stock went on a downtrend, basically two things happened in the summer of 2015 that started this underperformance in PDCO. The company used to be predominantly in two businesses, rehab business and dental business. They decided they wanted to get rid of the underperforming rehab business. So they went to an equity firm, in the private equity firm, and they decided to dump their what was the business called? I'm trying to remember. It was back in August of last year. It was just basically just called a medical business sale. I don't know exactly what the name of the business unit was, but they sold the medical business to a private equity firm in June of 2015 for $715 million. This high tech that you see right here. And then in July, within a month after that, they used the cash proceeds to expand their business in animal health by an acquisition of IHS. That's the name of the company that they bought. It's an animal healthcare business for $1.1 billion. So they shuffled the business significantly. They got rid of the rehab business and they used the cash proceeds to get into the animal healthcare business. Now the company already had animal healthcare business, but by adding that $1.1 billion acquisition really dramatically increased their market share and gave them the pricing power. Why is this important? I want to show you something that I wrote for the front page that probably not many people paid attention to. So here is my note from Jaguar. Just go to the Jaguar Analytics website, go to the search, and type in the symbol WOOF, W-O-O-F. And you're going to see on May 16, which was, a month and a half ago, I wrote this article for the front page for free for everybody to see. I don't know if people paid much attention to that. Pet adoption accelerated in April. Positive for WOOF and IDXX. Two stocks were mentioned at the time in this article. All right? And so basically what I was showing was that both of these stocks, WOOF and IDXX, which are absolutely pure play on animal health, all right, they are seeing significant amount of acceleration in April, which, by the way, later on in a separate note, I saw the same thing happen in May as well. So I'm expecting both of these companies to report very, very good earnings in a couple of weeks, and they have been very, very strong charts. The trends, the channel checks are very strong for WOOF and IDXX. Guess what? After you read that article, PDCO bought an animal healthcare business right here in July of 2015 last year for $1.1 billion. It only makes sense to me when I extrapolate based on my own article that I wrote for the front page back in May that what's good for pure plays like WOOF, this is WOOF chart, a beautiful strong trend, and IDXX right here. What's good for these pure plays is animal business is going to have the same kind of positive impact on PDCO because it has doubled its presence in the animal healthcare business. So that growth driver, in my opinion, is not fully baked into consensus view because when I look right over here, I'll show you. This is from the Ameritrade, and if I go here and I show you the PDCO earnings trends, right here is when they bought in the summer of 2015. Let me make this bigger so you can see. The consensus estimate in the summer of 2015 for fiscal year 2017, let's call it, for 2017 earnings was $2.76, and almost a year later, it's $2.66. The consensus for fiscal year 17 and fiscal year 18 has not moved at all, despite dumping an underperforming business a year ago, which had to do with the medical supply unit, which was sold to a private equity firm, and a higher margin, higher growth business acquisition in the animal healthcare business that is showing incredible channel checks. Starting from April, and the consensus has not moved the estimates higher. So that right there is a disconnect in the story, and I believe that's not fully baked into consensus view. Separately, what I'm going to show you is right here. This is the note from Credit Suisse. It came out on July 1st. So this was Friday of last week. This is as latest as I could get. All right. I'm going to quickly take you down to one note that basically caught my attention on this one. Right here. Couple notes actually. This is coming directly from the management meeting with Credit Suisse analysts, which has been following the stock very closely. The dental market is growing 3% currently, but PDCU expects it to improve to 5% longer term. The vet market is growing faster currently at around 5%, and PDCU should do better than that in the longer term. Again, this is exactly what I was trying to say. Okay, it could see increase in profitability in the 50 basis point range. There was another, just to give you a background over here, the company actually went through, aside from shuffling the portfolios last year, the company went through another major restructuring in the firm. Basically, the company is laying off 1 to 2 sales rep in every 80 or so dental locations nationwide. The reason is that the sales are gradually moving from dental offices to online for a lot of over-the-counter stuff that people buy, that for things that people don't necessarily need to go see a dentist to actually buy. That transition has led the company to make higher than expected capital investments in ERP implementation, which is the system to build out an online channel for sales, and that means lower free cash flow last year, which now should start to pay off going forward as margins improve. That's what this is talking about, because basically the CapEx plan that we saw over the last 12 months is finally coming to end, which means you're going to see CapEx go down, free cash flow goes up, and that means free cash flow margins increases from here. That should also means the multiple should expand from here, even if the top line revenues stays the same. Okay, the multiple should expand as EPS will be faster than the top line revenue growth. Bottom line is this: you have a major disconnect between 11 times enterprise value, 11 times EBITDA. The enterprise value is 11 times EBITDA versus the two other players trading at 13 times this year and 15 times next year. At the same time, when the margins should improve, and the entry into animal healthcare business with the checks that I reported back in April on the front page should show that the animal healthcare business is growing dramatically. So I see a disconnect in the story. I see the forward consensus that has not moved for 9 months should continue to do much better, all right, going forward. And so you should see consensus move higher probably by my calculation. I did the separate method on Excel spreadsheet earlier. It should move by as much as 22% above where it is today, which means I don't buy the consensus is going to be only $2.65 EPS for 2017. I think you're going to see that move higher towards $3.25 or $3.30, which means that the EBITDA over enterprise value valuation drops even lower, probably to 7 to 8, which makes the stock stupid cheap. I mean, that's the bottom line over here. The stock is stupid cheap compared to the shuffling of the portfolio that has taken place. All of this is explained over here, and I put my own thoughts into this. So I'm just keeping it short and sweet, just giving you the bullet points. Otherwise, I can just go into detail and write a book on it. So the bottom line is this. The chart is breaking out. You want to be long this name, and your target is $53, which is right over here. But as we usually do, I'm going to actually watch the markets carefully to see how this is performing relative to the entire sector, medtech sector, as well as everything else. Here's what you need to keep in mind in big picture. Woof. This is a pure play on the pet supplies, and and the other one is IDXX, another pure play on medical supplies. Both are doing very well. The channel checks are strong, and with increased exposure to this business, I expect PDCU to perform better as well and catch up on valuation with the rest of the group. So that's my bullish view.